The morning of the 15th of September 2008, Richard Fuld walked into Lehman Brothers headquarters for the last time as CEO, watching 158 years of financial history crumble beneath his feet. Thousands of employees streamed out carrying cardboard boxes, their life savings evaporated in company stock, their mortgages suddenly looking insurmountable. Yet across town, John Paulson was quietly calculating his profits from betting against the housing market $15 billion in a single year. This stark contrast wasn't an anomaly, but rather a perfect illustration of an ancient pattern that repeats with clockwork precision every time economic disaster strikes. Picture Maria, a single mother working 2 jobs in Phoenix during 2008. She'd saved diligently for 5 years to buy a modest home, believing in the American dream that property ownership meant security. When the crisis hit, her restaurant cut her hours in half, and her second job at a retail store disappeared entirely. The adjustable rate mortgage she'd been assured she could refinance suddenly jumped from manageable to impossible. Within 6 months, she joined millions in foreclosure. Her savings gone, her credit destroyed. Meanwhile, private equity firms were raising billions in new funds, preparing to buy distressed properties at 30 cents on the dollar. This divergence isn't accidental or merely unfortunate, it's structural, woven into the very fabric of how modern economies function. To understand why crises create such devastating inequality, we need to first understand what actually happens when an economy collapses. Imagine the economy as a vast ocean where different people sail different vessels. The wealthy cruise in massive yachts with sophisticated navigation systems, multiple engines, and months of supplies. The middle class navigate in decent sailboats, generally seaworthy but vulnerable to serious storms. The poor paddle in rowboats, barely staying afloat even in calm weather. When an economic hurricane hits, the rowboats are swamped immediately. The sailboats might survive the first waves but eventually succumb without help. The yachts? They've already received weather warnings from their sophisticated systems, moved to safer waters, or even positioned themselves to profit from salvaging the wreckage of smaller vessels. This maritime metaphor captures a fundamental reality. Economic resilience is directly proportional to existing resources, and crises amplify these differences exponentially. Consider what happens at the first sign of economic trouble. Wealthy individuals and institutions have access to information networks that most people can't imagine. Investment banks employ thousands of analysts who do nothing but monitor economic indicators. Hedge funds pay millions for data that arrives microseconds faster than public information. When Janet, a successful hedge fund manager, sees troubling patterns in mortgage default rates in early 2007, she doesn't just protect her wealth, she positions it to multiply. She shorts mortgage-backed securities, buys credit default swaps, and moves capital to safe havens like gold and treasury bonds. Compare this to Robert, a factory supervisor in Detroit. His first indication of crisis comes with a pink slip in October 2008, by which time the smart money has long since repositioned itself. His 401k, invested in mutual funds he barely understands, has already lost 40% of its value. With no liquid savings beyond a few $1,000s, he can't take advantage of the buying opportunities that financial advisors keep mentioning on television. Instead, he's forced to withdraw from his decimated retirement account, paying penalties and taxes just to keep his family fed and housed. This information asymmetry represents just the first layer of advantage. The second, perhaps more crucial factor, is liquidity simply having cash available when everyone else desperately needs it. During the Great Depression, Joseph Kennedy, father of future President John F. Kennedy, famously said he knew it was time to exit the stock market when his shoeshine boy started giving him stock tips. He converted his holdings to cash before the 1929 crash, and then deployed that cash to buy valuable assets at Depression-era prices, including real estate that would eventually be worth hundreds of times what he paid. The pattern repeated in 2008 and again during the COVID-19 pandemic. When markets crashed in March 2020, millions of workers lost jobs overnight. Small business owners watched decades of work evaporate as lockdowns shuttered their restaurants, shops, and services. They had no choice but to sell assets, homes, cars, business equipment at whatever price they could get. But who was buying? Institutional investors, sitting on massive cash reserves, waiting for exactly such opportunities. Blackstone, one of the world's largest private equity firms, raised over $20 billion in 2020 specifically to buy distressed real estate. They weren't alone across the financial industry. Firms that had maintained liquidity through conservative positioning or access to cheap credit were able to purchase assets at generational lows. A small apartment building that sold for $2 million in 2019 might fetch just $1.2 million from a desperate owner facing bankruptcy in 2020, only to be worth $2.5 million by 2022. This brings us to the third critical factor: access to credit. When crises strike, credit markets freeze for ordinary people, but remain surprisingly fluid for the wealthy and well-connected. After 2008, the Federal Reserve slashed interest rates to near zero and initiated quantitative easing, essentially printing money to buy bonds and inject liquidity into the financial system. But this liquidity didn't flow equally. Banks, burned by bad loans, tightened lending standards dramatically for small businesses and individuals. Credit card limits were slashed. Home equity lines, frozen, and small business loans became nearly impossible to obtain. Yet for large corporations and wealthy individuals with pristine credit and substantial assets, money was practically free. They could borrow at 1 or 2% interest to buy assets yielding 5, 7, or 10%. This arithmetic seems simple, but its implications are profound. If you can borrow $1 billion at 2% to buy apartment buildings yielding 7%, you're essentially being paid $50 million annually to be wealthy. This opportunity is categorically unavailable to someone who can't qualify for a $10,000 business loan to keep their restaurant afloat. The story of Sarah and David illustrates this perfectly. Sarah, a successful dentist, had built a thriving practice over 15 years. When COVID hit, she was forced to close for 2 months, then operate at reduced capacity for a year. With high overhead and no income, she exhausted her savings and maxed out her credit cards. When she applied for an SBA loan, she was told the funds had run out, allocated mostly to larger businesses, with sophisticated legal teams who knew how to navigate the system quickly. Facing bankruptcy, she sold her practice for a fraction of its value to a dental consolidation company owned by private equity. David, managing partner at that private equity firm, saw COVID not as a crisis, but as an opportunity. His firm raised $2 billion in new capital from pension funds and endowments, borrowed another $3 billion at rock-bottom rates, and went shopping for distressed dental practices. They bought Sarah's practice and dozens like it, creating a dental empire that would generate hundreds of millions in profits as the economy recovered. Sarah now works as an employee in the practice she once owned, while David's net worth doubled in 18 months. This process of wealth concentration during crises isn't new, it's as old as recorded history. During the Roman Empire's various economic crises, wealthy patricians would buy up small farms from indebted peasants, creating vast latifundia estates worked by slave labour. The Black Death in 14th century Europe killed a third of the population but allowed surviving wealthy merchants to consolidate land and resources, setting the stage for early capitalism. The Panic of 1873 saw Cornelius Vanderbilt and John D. Rockefeller expand their empires by acquiring bankrupt competitors for pennies on the dollar. Each crisis follows a predictable pattern: initial shock, where everyone loses on paper; liquidity crunch, where those without cash reserves face ruin; asset price collapse, creating buying opportunities; and eventual recovery, where those who bought at the bottom reap enormous gains. The wealthy can afford to play this entire cycle, while the poor and middle class are usually forced out during the liquidity crunch, crystallizing their losses and missing the recovery. Modern financial systems have added new twists to this ancient pattern. Derivatives allow sophisticated investors to profit directly from decline. You can literally bet on other people's misfortune and win. During 2008, while families lost homes to foreclosure, investors who had purchased credit default swaps against mortgage-backed securities made billions. The instrument that allowed this, the credit default swap, was virtually unknown to the public, but generated profits that dwarfed anything available in traditional investing. Moreover, the interconnectedness of modern finance means that those with resources can achieve global diversification while the poor remain tragically localized. When Turkey's currency collapsed in 2018, wealthy Turks had already moved significant assets to dollars, euros, and Swiss francs. Middle-class Turks watched their life savings halve in purchasing power overnight. The wealthy had financial advisors in London and Zurich. The middle class had savings accounts in Istanbul. Government responses to crises, despite often good intentions, frequently amplify these inequalities. Central banks' primary tool, monetary policy, works through financial markets, inherently favouring those who own financial assets. When the Federal Reserve cuts interest rates and buys bonds, it directly increases the value of stocks and bonds. Who owns these assets? The wealthiest 10% of Americans own 84% of all stocks. The bottom 50% own essentially none. Fiscal policy, government spending, and taxation theoretically could address inequality more directly. However, the political influence that accompanies wealth often shapes these policies too. The 2008 bank bailouts saved financial institutions whose recklessness caused the crisis, while millions of homeowners received minimal help. The PPP program during COVID, meant for small businesses, saw hundreds of billions flow to large companies, while mum-and-pop shops closed forever. This isn't necessarily corruption, it's the predictable result of complex systems designed by and for those who understand financial complexity. Even well-intentioned policies can backfire. Unemployment benefits and stimulus checks during COVID helped millions survive, but they also drove inflation that eroded purchasing power. For wealthy individuals with assets that inflate in value, real estate, stocks, commodities, this was a windfall. Their houses appreciated 30%, while their fixed-rate mortgages became cheaper in real terms. For renters living paycheck to paycheck, that same inflation meant choosing between food and medicine. The psychological dimension of crisis wealth transfer deserves attention too. When facing economic devastation, people make decisions they would never consider in normal times. The owner of a family business built over generations might sell to a competitor for a fraction of its value because the alternative is losing everything. A homeowner might accept a lowball cash offer because foreclosure looms next month. These aren't irrational decisions, they're the rational responses of people with no alternatives. But they systematically transfer wealth from the desperate to the liquid. Professional investors understand this psychology and explicitly strategize around it. Warren Buffett's famous quote about being fearful when others are greedy and greedy when others are fearful isn't just folksy wisdom, it's a precise description of crisis profiteering. When panic selling drives prices below fundamental value, those with capital and emotional distance can generate extraordinary returns simply by maintaining composure and liquidity. The technology revolution has added new dimensions to crisis inequality. High-frequency trading firms can now execute thousands of trades per second, profiting from microscopic price differences invisible to human traders. During the March 2020 market crash, while retirement accounts hemorrhaged value, these firms recorded their most profitable days ever. The same technology that theoretically democratizes finance online brokers, robo-advisors, cryptocurrency often becomes another venue for transferring wealth from amateurs to professionals. Consider the GameStop saga of early 2021. Retail traders organizing on Reddit briefly squeezed hedge funds betting against the video game retailer, creating a narrative of David versus Goliath. Yet when the dust settled, the vast majority of retail traders lost money, buying at inflated prices and selling at losses. Meanwhile, sophisticated firms like Citadel Securities, which processes retail order flow, made billions from the volatility. The revolution was televised, but the outcome was traditional. Wealth flowed from many small pockets to few deep ones. Education, often touted as the great equalizer, shows its limitations during crises. A master's degree in finance certainly helps navigate economic turmoil, but it means little without capital to deploy. The most educated generation in history graduated into the 2008 crisis with record student debt and minimal job prospects. Their knowledge couldn't overcome their negative net worth. Meanwhile, those who inherited wealth needed only basic competence to preserve and grow it through the crisis. This isn't to say individual actions don't matter. Some people do navigate crises successfully through skill, luck, and determination. The immigrant who saves religiously and buys a rental property during a downturn. The entrepreneur who pivots brilliantly to meet crisis-created needs. The worker who retrains for a recession-proof industry. These success stories are real and admirable. But they're exceptions that prove the rule. For every crisis success story, there are thousands of equally hard-working, intelligent people who simply lack the resources to weather the storm. The concentration of wealth during crises also becomes self-reinforcing across generations. Children of wealthy families don't just inherit money, they inherit crisis resilience. They grow up hearing conversations about portfolio diversification, tax optimization, and market cycles. They attend schools where classmates' parents are investment bankers and venture capitalists. They enter adulthood with networks that include people who can provide capital, advice, and opportunities. When crisis strikes, they have both the knowledge and connections to navigate it successfully. Compare this to children from working class families who might witness their parents' small business fail or home foreclose during a recession. They internalize lessons about economic vulnerability, often developing either excessive risk aversion that prevents wealth building or desperate risk taking that leads to losses. They enter the workforce with student debt rather than family capital, limiting their ability to take entrepreneurial risks or invest in opportunities. When the next crisis arrives, they're positioned to repeat their parents' experience rather than break the cycle. Some argue this wealth concentration is economically efficient, that it puts resources in the hands of those best able to deploy them productively. There's partial truth here. Professional investors probably do allocate capital more efficiently than amateurs. But efficiency isn't the only value that matters, and the social costs of extreme inequality often outweigh any efficiency gain. When millions lose homes while thousands profit from their distress, social cohesion fractures. When working hard and playing by the rules leads to ruin while financial manipulation generates fortunes, faith in the system collapses. The political consequences are equally severe. Concentrated wealth buys political influence, which shapes policies that further concentrate wealth. This isn't conspiracy, it's interest group politics playing out predictably. Financial industry lobbying weakened regulations before 2008, enabling the crisis. Bank executives who created the crisis received bailouts and bonuses, while homeowners got foreclosure notices. The resulting populist anger drove political upheavals worldwide, from Brexit to Trump to the rise of extremist parties across Europe. Economic inequality and political instability are intimate partners. Looking ahead, there's little reason to expect this pattern to change spontaneously. If anything, trends toward automation, artificial intelligence, and climate change threaten to accelerate crisis-driven inequality. When artificial intelligence eliminates millions of jobs, those who own the AI will capture the value previously shared with workers. When climate disasters strike, those with resources will relocate while the poor remain trapped in increasingly uninhabitable areas. Each crisis will follow the ancient pattern destruction of existing wealth, concentration among those with liquidity, and reconstruction that favours capital over labour. Yet understanding these mechanisms isn't cause for despair, but rather foundation for action. History shows that extreme inequality eventually generates countervailing forces. The Gilded Age's robber barons gave way to progressive era reforms. The Great Depression produced the New Deal. The devastation of World War II led to social democratic policies that created the broadest prosperity in human history. These transformations didn't happen automatically, they required organised political action, intellectual leadership, and sometimes revolutionary pressure. The question for our time is whether we can implement reforms before crisis rather than after catastrophe. Policies exist that could mitigate crisis-driven inequality. Wealth taxes that prevent extreme concentration, automatic stabilizers that support purchasing power during downturns, financial transaction taxes that discourage speculation, public banks that maintain credit access during crises, sovereign wealth funds that give everyone a stake in national prosperity. These aren't utopian fantasies. Various countries have implemented versions of them successfully. The story of crisis inequality ultimately isn't about abstract economic forces, but about human choices. We've created systems that systematically transfer wealth from poor to rich during turbulent times, but we could create different systems. The same ingenuity that devised credit default swaps could design instruments for shared prosperity. The same political will that bailed out banks could bail out communities. The same trillions that prop up asset prices could build resilient economies that don't collapse at the first shock. As I write this, storm clouds gather on the economic horizon once again. Inflation, geopolitical tensions, unsustainable debts, and technological disruption threaten another crisis. When it arrives, we'll witness the same ancient pattern. The poor will lose what little they have, the middle class will struggle to maintain their position, and the wealthy will emerge even wealthier. Unless, of course, we decide to write a different story this time. The mechanisms are understood, the alternatives exist, and the choice, as always, is ours.